Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm going solo to bring you 3 top big cap stocks that aren't in the Mag 7. I know a lot of you are struggling to find things to buy that are outside of the Mag 7, or, you're just looking at where there could possibly be other opportunities. We all own the Mag 7. Let's be honest. If you don't own all 7 of them, you probably own like 4 or 5. We all own them in the S&P 500. So it might be nice to have a little bit of diversity in your portfolio. But what else is out there? It's been so easy to own the Mag 7s that we tend not to look around at other good quality companies. So I'm bringing you 3 this week that I've been keeping an eye on for years. And they look like they might be kind of on sale now. At least two of them are. So let's dive right in. I'm going to be sharing my screen again on Zacks.com so we can look at the earnings. We can see what the Zacks ranks are. We're going to look at a few charts just to see what's going on with some stocks outside of those Mag 7s and mostly outside of the AI revolution. So what does that mean? Some of these are just really old economy stocks. That's what I call them. That's not a dig against them, not at all, because as we've seen in certain sectors like the railroads are bigger than ever. And some of them have been around almost, not quite 200 years, but about 175 years, give or take. So let's dive right in. I'm going to start with the big kahuna, and I'm going to stay on that railroad theme with this one. Berkshire Hathaway, ticker BRK.B. I've been talking about it quite a bit this year, ever since Buffett announced that he would be retiring at the end of the year as CEO. He is going to stay on the board. He is 95 now, so none of this should be surprising. We're only just kind of surprised that he's not going to live forever, but he is going to step aside a bit, and that has been impacting Berkshire Hathaway shares. People are just uncertain on how Greg Abel is going to run the company. And then these are companies within Berkshire Hathaway that are the old economy. I'm thinking off the top of my head here, I don't think they own any companies that are really AI specific other than maybe on energy, which, obviously is going to be used to fuel these data centers. So they do have a little bit of a play on it on that side. But remember, they own See's Candy, Dairy Queen, the auto retailers. They own the Geico, obviously, insurance. They own some reinsurance. They do own the big flagship BNSF Railroad, as I was just mentioning. So that is serving them well. They've been in the news because there's been a lot of talk about them maybe acquiring CSX in order to compete against UNP and Norfolk Southern trying to do their deal. But Buffett has put the kibosh on that for now, so we're not going to get that. But the rails remain hot. It's still a form of transportation all these years later. And there's only about 4 or 5 big railroads now crisscrossing the U.S., and Berkshire Hathaway owns one of them. So that's one of the reasons I like them. So let's take a look at what is going on. So over the last year, Berkshire Hathaway shares are up only 9%. That's underperforming the S&P 500 now, which is up 15.5. But it had been hitting new all-time highs into the Buffett announcement, and then it's kind of pulled back a little bit. As you can see, it's a number 3 on Zacks rank, and style scores are all pretty low here because the shares have gotten pretty pricey here. Just scrolling down, looking at the forward PE, it's at 24.6, which compared to the other like Mag 7 stocks is cheap. but not for Berkshire Hathaway and the types of company it owns and its growth rate. So this is among the more expensive forward PEs that Berkshire has had in quite some time. And even look at the PEG ratio, 3.5. That's not cheap either. And so you're getting a little bit of valuation issues, I feel, with Berkshire. It is $1 trillion market cap. So if you're thinking, what else is there outside of the Mag 7s of these big mega caps? People often forget about Berkshire, but it is now in that $1 trillion market cap club. But you can see on this price consensus and surprise chart a bit of a weakening in both 2026 and then we now have some 2027 estimates coming down just a bit. Kind of looks like 2026 is now expected to be flat compared to this year. But again, old economy, and maybe it is pricing in some of this slowdown that we're seeing. So for instance, they do own a paint company, and the paints and coating side of the housing industry has been really slow. Sherwin-Williams earnings also on the decline. So you're going to see that even with Benjamin Moore. There's a lot of moving parts again with Berkshire Hathaway. That's also why we don't have a lot of estimates on it. There's a lot of journalists which cover Berkshire Hathaway, and they cover the annual meeting and what happens in the quarterlies, but not actual analysts. As you can see, we have just one estimate on the sales side and just 3 on the earnings side. Earnings expected to decline this year, 7.7%, and then gain just 2.1 next year. They do have that massive cash hoard. They are still building their cash. They're at $350 billion on the cash side. This leaves a lot of people wondering, when will that money be deployed? It is invested, so it is making money while it's sitting there, but it is underperforming the S&P 500 right now, even with being invested in treasuries and other things. So, I still like Berkshire. I like its businesses. I'm an old economy type of investor myself. But with a recession, old economy isn't necessarily where you want to be. We might see some more weakness in the earnings and then in the shares with a recession. So I'm waiting maybe for these to get a bit cheaper. They did here, if you look at this little mini 3-month chart here, you can see in August, they did weaken quite a bit, had a nice rally and come off a little bit here in September. But if we can get a little bit more weakness again, I might be getting interested. But even Buffett isn't buying his own shares anymore. And he has said he will only buy when they're cheap. And as we've seen, even a PE or a PEG ratio, they are not cheap. So that's Berkshire Hathaway. It's the all-in type of play, all in except AI. That's what you get when you buy Berkshire Hathaway. Does still have a big position in Apple, even though it has been selling off some of that, and still owns Bank of America and American Express. So you're still getting some financials on its equity portfolio side. But I'm waiting for it to get cheaper. I'm going to be patient on Berkshire Hathaway. So that's BRK.B. Then let's switch over to my other favorite old economy company, Fastenal. Yes, I'm talking about Fastenal again. F as in Frank, A as in Adam, S as in Sam, T as in Tom is the ticker. They are in, as we can see here on Zacks.com, their industry is industrial services. They make fasteners. That's one of their big things, but they also do safety products like the N95s and things like that for the construction industry, but then they were deployed during the pandemic. So that side of their business really soared during the pandemic. It's come way back down. And this is a good barometer on manufacturing, always, Fastenal, but it has been struggling the last couple of years, really. But the stock has not. 1 year, Fastenal shares up 37% over the last year. It has been hitting new highs. And so that is, easily beating the S&P 500 over the 1 year period, which is up just 15.5%. Market cap of 56 billion. That's still a big cap. It sounds small compared to Berkshire Hathaway at $1 trillion. This seems tiny, but it's not that tiny. And look at this chart. Like I said, it is hitting new highs again, and it's pulled back just a little bit, but trying to break out again. The earnings starting to turn around and going higher here, even here in 2025. And then in 2026, the analysts getting more bullish. And now we're getting 2027 looking like some more earnings growth. What does this look like on the detailed estimates? It should look pretty good. Okay, so scrolling down, we can see here's the one. We've had one estimate that's higher. We have 9 total estimates, but one analyst getting bullish in the last 30 days, both for this year and next. So that's where some of the sentiment might be improving a bit. 11% earnings growth for this year and 10.7 for next year. Very, very respectable to do the double digit. On the sales size, 8.9 and then 9.3. I'm liking that because it's not a super strong 20% growth type of company, but these are solid numbers, almost, at the double digits. And then, just looking down, you can see where the one analyst, well, you don't even really see it here, but we have had the one that's raised in the last 30 days, but we're kind of stuck at 111 for this year, 123 for next year. Very consistent. And it usually has like small beats or meets, as you can see. It does have one miss, but it just missed by 1 penny a couple quarters ago. So this is also very consistent because they're very good at telegraphing what's going on in the business to the analysts. It's a number 2 buy. Berkshire was a number 3 hold. Not surprising, but this is where it gets a little dubious for me as a value investor. PE is at 43.98. So 44 times we're paying for Fastenal. It used to be stuck right around 30 for the last couple of years. But now that the stock is broken out, yes, it does have some good fundamentals, but people are paying 44 times on the PE now to get those earnings. PEG ratio of 4.44. That's also very high on a PEG ratio. And if we go to the financial overview page on Zacks.com, which I'm doing right now, this is where we get like price to sales, price to cash flow, price to book is at 14.7, price to sales 7.2. All of this is extremely high. Yes, it has some of that growth there, but that's not good enough growth for me at this price. But what do I know? Everybody else is buying it as it's trading near the all-time highs. It has a good track record of meeting or beating. And once manufacturing actually comes out of the recession, what are those earnings going to do? That's probably a ways off into maybe late 2026 is what I would estimate. But once it does, we should maybe see a little bit stronger growth there on both sales and earnings side. So Fastenal is a play on the future. And everybody's getting in now thinking we're going to get the turnaround in 2026, even better than what we're seeing right now, because this is pretty good earnings growth for a industry that is struggling. So Fastenal still just really top notch and crushing it. And that's why we've got this number 2 buy ranking with those analysts getting a little more bullish as we head into next year and even for the end of this year. Earnings, well, for the third quarter coming up soon on Fastenal, just a few weeks away. So you're going to want to be tuning into this one as well. Old economy extraordinaire. People forget about it, but still executing on sales and earnings. Fastenal, ticker FAST. And then I'm going to wrap it up with big retail. Retail's been a little dubious because no one knows what the consumer is going to be doing. So you want to stick with the tried and true, the best of the best, and it's Costco, ticker COST. This one, number 3, I've been following it for quite a number of years. I do not own it. I know many of you do. it is a bigger cap than Fastenal, 406 billion on the market cap. Style scores got the A for growth, so it's still got that. I'm not sure about the F for momentum, but shares hit a new high earlier this year and then have not been able to break out and have been kind of just treading water. A D for value, and I'm going to get into that in a second. So Costco over the last year, the shares are up just 4.4%. And for people in Costco who have had a huge winner over the last 5 years, and then even before that, so over the last 10 years, it's kind of been disappointing to see it up only 4.4%. But it's done this in the past where it's kind of had a timeout and the valuation is kind of caught up to what the business is doing. So it takes a little bit of time for that to happen. And that's kind of where we are. But is this a buying opportunity now while we're in this holding pattern? Maybe, right? Let's take a look. So here's the chart. And you can just see on the earnings side, even without us going to the detailed earnings estimate page, it's a great chart up and to the right, straight across. Analysts know what is up. 2027 even looking like some great earnings growth there. Maybe that's why we have an A for the growth, because it looks like this. It also ends up meeting or beating quite often, only just the 3 earnings misses in the last 5 years. And it just had earnings, and we have another little mini beat here. It's got a little green arrow, just 1% on the earnings side, but it's enough to get that green arrow. Pays a little bit of a dividend, this one at 0.57%. Fastenal also paid a dividend. We didn't look to see what it was. I'm going to look right now. Why not? I don't want to get too far before I don't remember that we didn't talk about it. Oh, it's at 1.8% yield on Fastenal. I knew they try to keep it around a 2% yield for that one. So you are a little bit rewarded there if you are holding Fastenal, but you don't really need it since you're at all-time highs over there. But we aren't that far off with Costco either. And that kind of holding pattern is what I was talking about back here in 2022 and most of 2023. It was also in that kind of pattern as it was adjusting to a new valuation after the pandemic rally. And then it adjusted, and now we've got the big upturn, and now we're in the same kind of holding pattern. What do the detailed estimates look like on Costco since we just had their earnings? I'm sure they're moving quite a bit. Yes. Looking at the agreement, they're all over the place. So we have 3 that are higher for this fiscal year, 3 that are lower. We have 2 that are higher for next fiscal year, 2 that are lower. And everybody's been in between in the last 30 and 60 days. Now, why do we have so many adjustments over the last 60 days for a company like Costco? Well, they're the only retailer that is still reporting its same-store sales monthly. All the retailers used to do this back in the day, but then slowly over time, they've all thrown in the towel and they said, no, we're only going to give you same-store sales in the quarter. Except for Costco. They're still sticking with it. They're still being transparent. So the analysts are getting data on the same store sales every 30 days. So they can adjust their estimates a little more accurately when those sales data is coming in. So there's really no surprises when Costco reports. We're not like, did anyone show up this quarter? Is anyone buying from Costco? Is the consumer concerned? Because we've been getting those monthly sales reports in. So we already do have an idea about what's going on. But they do give some more nuanced details and tend to make other announcements during their quarterly reports. And that's what we're seeing here. But we have some new or some very good double-digit earnings growth expected for this fiscal year, 10.5%, another 10% for next fiscal year, on 7.8% sales growth for both years. This, like Fastenal, is very solid numbers, and you love to see it, right? Especially for a big mega cap retailer like this, where the growth is just harder to come by year over year to do 10% earnings and 8% sales. when they're already this massive size is very impressive. Now, what really is going on behind the scenes, similar to Fastenal and even Berkshire Hathaway, valuation. So it was trading above 50 times, but now that the stock is off of its highs and not still rallying, it's pulled back a bit, even with those earnings estimates being increased. PE is at 46 now, so it's a little cheaper than it used to be, but not much. And then look at this PEG, 5.5 on the PEG. So even with the double digits, 10% earnings growth, it's not enough with where this price is on the stock to really get that PEG ratio, much lower. Now I'm switching over again to the financial overview just to look at price to sales. So this is impressive though. This is the one area where it is still cheap. Price to sales ratio is 1.48. Now, 1 and under means it's a value. I didn't expect Costco to be a value on price to sales, but under 2, it's still pretty cheap. So 1.48 means we're paying basically $1.50 for every $1 of sales. That's not getting them on sale, but I'm not overpaying like I am with Fastenal, where it was 7.2. I'm paying $7.20 for every $1 worth of sales at Fastenal. So that's a big difference. That is, I'm really liking those sales. I really want them if I'm paying $7.21 for that $1 worth of sales. But here, I'm getting them a lot cheaper at 1.48, $1.48 for my $1 worth of sales. So that's the only area where Costco is still pretty attractive. I do like to look at the price to sales ratio. Tells you a lot about where a company is. And so I'm liking that. But Costco, will it just stay here? Will it break down more? If we get an actual recession, will we see a bigger pullback in Costco? We should with a lot of the retailers, because obviously people quit spending. And so I could get the stock a bit cheaper, perhaps, if I'm waiting on the sidelines. But it seems like the market wants to wait too. That's why it's trading in this narrow range. I'm not expecting any kind of breakout for it for the rest of this year. If anything, maybe we're going to get a little more weakness. So I'm just going to have it on my watch list here. All three of these, as I've mentioned before, because I have covered these on the podcast before, but these are kind of my bellwether type of companies. They're all very well run. They all have good balance sheets. And so these are ones I'd like to own if I could get them maybe just a bit cheaper for what their growth rate is. Now, I just put in Berkshire Hathaway for the financial overview. So their price to sales ratio is 2.91. Again, that's not that cheap. It's cheaper than Fastenal. Price to book is pretty attractive at 1.6, however. So I am liking that. So out of the three, Berkshire is the cheapest, but for Berkshire's business and historically for them, this is among the more expensive times in its history. So I'm kind of staying away from a slower growth company like Berkshire Hathaway than some of these that are doing the double digits. So to wrap it up, if you're looking around for top stocks that are not in the Max 7s, and these are large cap companies, I have a list of the mids and the smalls that I would love to talk about too, but we'll keep that for another podcast. We're sticking with the bigs for this one, but if you're looking to diversify out of that AI trade and into old economy, some of these are ones to keep on your watch list. Again, it's Fastenal, ticker FAST, Berkshire Hathaway, BRK.B on Zacks or -B on some other platforms, and Costco, ticker C as in Charles, O, S as in Sam, T, COST. I do not own any of these because they just were too expensive for my blood, but I am waiting, like I just mentioned, for a buying opportunity. They, if they pull back in a bigger sell-off, then I would be interested. Great fundamentals, again, good management, and they dominate their industries. And that's what we like to buy here, at least in these big caps. So keep these in mind. Try to diversify outside of the Mag 7. There is more to the investing world than the Mag 7s. I used to do a chart many times showing Fastenal. Let's do it right now. Fastenal and Microsoft over the years, 20 years. I think I might have even have done from inception. And Fastenal doesn't get the love Microsoft has gotten, with the Microsoft billionaires or millionaires, I should say, although some are billionaires now too. And how many people have really benefited from Microsoft's chart over the years if you've been a long-term investor there. But nobody really talks about Fastenal. And are there any Fastenal millionaires? There may be. Because look at this chart. This is the all-time chart. Microsoft went public in after Fastenal back here in the light blue. Oh no, Microsoft went public in 1986. So this is going back to 89. So Fastenal must have went public maybe in 89. But still, Microsoft is now definitely beating it on the all-time chart. Look at that, up 124,568%. Incredible. But look at Fastenal, up 60,205%. That's amazing. Let's switch back to the 5-year because most of us weren't owning either of these back in the day. Microsoft now has taken the lead again, but some of the time, even looking back here a couple of years ago, it was kind of more tied. But Microsoft on the AI play has now taken a bit of the lead. It's up 149% in the last 5 years. Fastenal up 119, as I mentioned. Also, in case you're curious, Costco beats both of these. It's up 160% in the last 5 years. Berkshire Hathaway also holding its own. It's up 137% over these last 5 years. The S&P 500 up 98.6. Not too shabby with that one either, but all of these stocks beating the S&P 500. Costco now beating Microsoft over the last 5 years, even with the AI trade. This is why I encourage people to have a diverse portfolio. You don't know where the winners are going to be out there. It's not all AI stocks. Keep that in mind. Okay, I'm finally wrapping up now. Thanks for joining us as always. And thanks for those of you who are subscribing on YouTube to our YouTube channel. Be sure to get us there so you can get the video podcasts. And otherwise, we're on Apple, Spotify, Amazon Music, anywhere you can get the podcasts. We're back. We're back to do podcasts through the end of the year now. And we're about to get third quarter earnings season. So a lot is going to be going on. Be sure to follow us somewhere. And I'll see you again next week with some more stocks.